CMHC financing? Is the cap going to increase? As well as, could we see 30-year AMs coming in for insured mortgages? One last thing, my folks, are we going to see the end of stress test for CMHC financing, especially when we're seeing mortgage renewals and mortgage switches from one lender to the other? All this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Beg. How are you, my man?
Hey, Gary, I'm fantastic. How you doing?
I'm doing well. We have definitely hit the fall weather. Look, I broke out the Canadian dinner jacket, so I'm wearing that already. There's some major things and major dates coming up, especially we're recording this on October 16th. Tomorrow, inflation numbers come out, which is in preparation for, the following week where we have the Bank of Canada, perhaps with an interest rate hold, a hike. I don't think they're going to drop it. Do you?
I'm pretty sure that's a guarantee.
Okay.
Right? I'm pretty sure the last time that, so the next time we can probably see a drop, everybody's saying is deep into next year. When, we don't know. But yeah, the question is, will it be a pause or will it be another 0.25? And tomorrow's inflation numbers will certainly inform the Bank of Canada as to what decision they might make. We have seen employment numbers being stronger than expected in the last little while as well. So, based on the data that we have on hand, it's more likely than not that we might see a little bit of a jump. But again, let's see what happens over these next couple of days. And let's cross our fingers that we've had enough. If the Bank of Canada is listening, trust me, we've had enough. We don't need another one. But yes. They're likely not listening.
Yeah. No, I know they tune into our show every week just to make sure, just to see what two yahoos are talking about. It's funny because, you kind of get conflicting news reports with, people looking for jobs and lineups around the corner at some locations. And yet, we're seeing the jobless rate, where that lines and what the reality is isn't quite what we're envisioning with, especially with inflation numbers coming out, because I know, some of the higher end jobs people are tending to lose, and a lot of the service industry jobs, people are going after those, right?
Yeah. And there seems to be still a lot of vacancies after COVID, even restaurants and those types of workers those types of establishments still trying to onboard workers to fill the need there, right? It's still there. So you are correct. Yeah.
Yeah. And we're starting to see a slight more increase every month or every week, we could say, Dion. I don't want to use the word distressed because that allows all the alarm bells and the naysayers to jump on and say, see, I told you so. But we are seeing a slight uptick, like a 0.01% of sales coming to market because they have to sell for financial reasons. And of course, that's the ripple effect when we're in times like this. But I know you had been following along what the Mortgage Professionals Canada, they went to Ottawa a week or two ago with some suggestions, or kind of like a think box, if you will, talking to the Bank of Canada and those that be. Talk to us about some of the key points coming out of those conversations.
Yeah, there's 4 key points that I want to discuss today that they took to Ottawa. The first one being the fact that CMHC mortgage insurance, so mortgage insurance in general, has generally been only available for properties for the value of $1 million or less. And, when that rule was established, must have been at least 5+ years ago, it made sense. But as property prices have continued to increase, it's often the case that first-time home buyers or even second-time home buyers do not have the 20% down that they would need to buy the property that they need to get into. And that property is, over $1 million. So what they've been discussing for quite a while and what they've now sort of formally taken to the Hill is that they would like to ask them to increase that minimum from 1 million to 1.25 million, which I think it's a correct move. But also it's it's a pretty big comment on society when we actually need insurance above $1 million in terms of on society on the on where our property market is, right? When now we need insurance on properties more than $1 million, because just let's face it, mortgage insurance is usually where first-time home buyers are involved, right? So if we're now saying that first-time home buyers are needing to buy at 1 million plus, then that's the nature of where we are. And yeah, 1.25 million is probably going to help some people, but it does go back to this conversation that you and I have been having, Gary, in that those people who are buying at 1.25 and let's say they're first-time home buyers, they're still not doing it by themselves, are they? They're still getting help from family, and so I just see this as another sort of feeding into this great and ever growing divide between those who can afford that number. And I mean, keep in mind, to buy a property at 1.25 million, we're needing an income upwards of $200,000 today. So that's a big jump from what it used to be back when you and I bought our first home, or even just a big jump from just 5 years ago. But so that big one, that big first one, increased mortgage insurance on the price of properties from 1 million to 1.25. The second one there is, and this one does make sense in my mind, it makes a lot of sense, and it's reintroducing an extended amortization for insured mortgages. So back in the day, we used to be able to get insured mortgages at 35 or 30 years. And years ago, they dropped that down to 25 years. So if you're taking a mortgage, you have to take a 25-year mortgage, a 25-year amortization. And so what that does is, and I've seen enough of these amortization schedules, that extra 5 years is generally going to drop your mortgage payment by anywhere from, say, $200 to $500 for most people. And what that means is that you can afford to buy a slightly more expensive property, which then means that you're probably going to get the type of property that's going to serve, you and your family. So, in terms of can I just ask you, Gary, in terms of the first-time home buyers that you've worked with, have you noticed that, that extra 50 or 100 grand will actually help them get that thing that they need?
Well, I'm stumbling on my words, but here I think my thought is that it allows some of those tertiary markets outside of, and you and I practice mostly in the GTA. Now you might not have to jump an hour away from Toronto or an hour and a half away from Toronto to the city core. It just might bring you that much closer, or right on the train line, if you will, and it provides just a little bit more opportunity, I believe, for some of those buyers. And think about this too. If we are in a market currently here in the middle of October where listings are popping up everywhere and buyers are having choices.
Yes.
So
yes.
if there's any sort of product or help or support from the government that introduces new buyers or more buyers, I think that's a good thing, right?
Yep. And this extra 5 years in amortization on insured mortgages will, in most cases, translate to anywhere from sort of 50 to 150 grand in extra borrowing power, depending on the borrower. And so, that would definitely help the market move forward for a lot of these first-time buyers who are sitting on the fence simply because they can't quite make the numbers work for them, right? So that's certainly a big one. Okay.
Yeah. And how would that, so the question for the mortgage broker in the room, how does that look from a borrower's perspective? Not to dive down through the qualification, but just perhaps the additional insurance cost. It obviously, for those that aren't familiar, it does get added on to the principal amount that you borrow, right? But it does help them, in a sense, look at perhaps a different level of inventory, correct?
Right. Yes. So in terms of mortgage insurance, and I'll just use $100,000 borrowing as a simple number. If you're putting down the bare minimum, which is 5%, we're looking at a mortgage insurance premium of 4%. So if you're borrowing 100,000, the mortgage insurance would be $4,000. Okay. Now that $4,000 is added to your total borrowing. So what that means is you're not reaching into your pocket to pay the insurance company, CMHC in this case, $4,000. It means that the lender will be lending you $104,000. And yes, you'll be paying interest on the entire amount, right? And so people look at that as a negative, and I can understand that. On the flip side, though, by being able to buy a property with less than 20% down and being able to get into the property market today, as opposed to waiting 5 years to save, or 10 or 20 years based on how long it would take some people, you're better off getting your foot in the market and paying that slightly higher insurance premium and then paying the interest on it. And then, sorry, what was the second part of that question, Gary?
Well, and no, that actually sheds a lot of light on this too, especially for those that aren't familiar with how CMHC works, or that refresher. You know, the additional cost of that 4,000, or if it's a $500,000 mortgage, of course, it's 5 times that, 20,000 in a sense. But
Yes.
the additional cost is sometimes still manageable in a sense, and as you said, outweighs waiting to buy a property in 5 years from now. And this is also where I know you, in the last probably 6 or 7 years, we started seeing first time home buyers, in this case for this conversation, get a little help from mom and dad, or the bank of mom and dad, or family.
Yeah.
And that's really what kickstarted it, because if they had 10% down, if they can come up with another 10%, it actually, or even 15%, can come up with another 5%. It made sense to
Yes.
remove the CMHC financing. But
Correct.
so there's all different ways to look at it. And now we're seeing, and as you know, we're seeing more and more help come from family members, in a sense, even without the 20% down, right?
Oh yeah, I mean, you think about it. 20% down on $1 million is $200,000, and so a lot of people can't even quite make it there. So we're helping people, and keep this in mind. Going back to the first point, you can't buy an insured mortgage. You can't get an insured mortgage on $1 million. So your purchase price, and this is why on MLS, Gary, you've probably seen it. Many properties are listed at $999,900, right? Because they know that they're appealing to the first-time home buyer who needs that mortgage insurance. But yeah, you're going to need still, on that purchase price. And actually, let me sort of expand on this. 5% down is the sort of the number that people think about when they're looking at mortgage insurance, but it's anything less than 20% down. So if you're putting 19% down, you're still going to pay mortgage insurance. It's just the premium scales down from 4% down to, say, 2.8% on the lower end, right? But yeah, it's still a lot of money, and even with the help with parents, people still aren't getting to the 20% down. Yeah, I've seen that quite a bit.
Yeah, yeah. And before we move on from this, because it's an important conversation, and for those that are keeping track, is CMHC financing on the residential side available to investors? Duplex, fourplex, that type of thing.
So there's a tricky answer to this, and the answer is technically yes, right? But the way it works is, when we're doing, say, a regular single family home, a lender will basically pass that premium on to the client in the form of that premium that's visible, right? The way it works with these other rental type insurance is, it's quite complicated. They'll pass on that cost to you. The cost is quite significant. It could be built into the rate, meaning that the interest rate is significantly higher, or they might actually charge you the premium. So it's possible, but let me tell you this. In my nearly 20 years in this business, I haven't had any clients do that, because it just doesn't make any economic sense. So if they're investors, they're gonna put 20% down. If they're a first-time home buyer, though, and they're buying a fourplex, and they're going to reside in one of those 4 units, yes, CMHC insurance is still available under regular terms.
Yeah, yeah. So there are some, not to say ways around it, but some creative ways as a buyer to look at that. And we're seeing more and more buyers look at properties that have that rental income, or a mortgage helper, as sometimes we like to refer to it as. Good stuff. Okay, moving on. What do you got? What came out of that conversation?
Yeah. So the next one here is this discussion that you and I have also had regarding the stress test as it relates to mortgage renewals. Okay, so I'll put it simply. You're with bank number one. You qualified years ago when interest rates were lower, and the stress test was at around 5%. You're coming up to the end of your 5-year term, and you've got, say, 300 grand left owing on your mortgage, and your bank is offering you a certain new rate. You want to explore the rate with a different lender, but the different lender now has to qualify you at a rate of 8% plus because the stress test has jumped so dramatically. And I've heard this a lot. People feel like they're prisoners of their mortgage, or their lender has got them captive, which is true because maybe now they can't qualify under this new high stress test. So the conversation that they've had is to remove, or what the ask of MPC to the government is to remove the stress test as it relates to mortgage switches. Okay, that is simply taking this $300,000 from this bank over to this bank so that you can maybe get a better rate. It's made shopping for a better rate much more difficult for people. And it really is, and I'll say it clearly, it is anti-competitive. It is making it harder for the regular Canadian to find a better mortgage. And so this is one which, in my mind, is a no-brainer, right? If they qualified for it, if they've never missed a mortgage payment, at least make it easier. Now, to be clear, this is called a switch. This is a big distinction. This is not a refinance where you're asking for more money, right? This is simply taking the exact amount of money that you have with lender number one and moving it over to lender number two. And I think in that regard, this is a very simple ask. And if this is something that the government doesn't entertain, I would say they're not doing their job for Canadians here.
Yeah, I like it. And I like the competitiveness of it because right now banks, they know you've got to go through the washing machine, if you will, to change lenders, and they use that to their advantage, right? That's I think
Most definitely.
I think that would, not to say it's an easy one to implement, but that's one I think they should seriously look at for sure. For sure. What else? Is there anything else that we should be
Yeah,
aware of?
and this last one here, and I'm going to read it because there's a lot to cover.
Mm.
So this one here is talking about establishing a permanent housing roundtable, right, for the federal government to take lead on establishing and discussing issues with housing with territories, municipalities, along with civil society organizations and industry, including the home financing and real estate sectors, to address the housing crisis. And that is the key word here, crisis. Like, if we haven't yelled it from the rooftops loud enough already, Gary, we have a big issue here. Supply is down, population is up, and everybody loves pointing the finger, right? And things get delayed when we go from municipality to federal to province to municipality and then to industry. Like, everybody loves pointing the finger, but we need to flatline this thing, and we need people to say, okay, why are we making this harder and slower than it needs to be able to quite simply build, right, and allow Canadians to get into home ownership? And I think this makes a lot of sense because by having this round table, and in my mind, a round table means that everybody is equal and they meet frequently so that they can put ideas on the table and move those ideas forward quickly, right? So that's what would be needed for this round table to work. And if that was to happen, I would say that a lot of the stuff that you and I talk about, complain about, yell about, could very likely go away. So that would be a wonderful thing to see.
That would be. And here's the interesting thing too, is, I spoke with a colleague of mine that sells a tremendous amount of condos or pre-construction here in the GTA. And, of course, he's in the know and rubs shoulders with the developers. And he's like, yeah, there's many developers that are putting project releases on hold
Mm-hmm.
because of where the financial situation is. They know if they bring something to market that people just don't have the funds for it right now. And that you have the other side of the coin. Well, we need more inventory, just as you said. We need more affordable housing. We need more housing. And now you have groups out there, whether they're in the government or not, saying we need to force these developers to build. Well, that's like forcing you to go buy something you're not willing to go buy. So it's an interesting conversation. And yes, we need to have these roundtables and more conversations. And I don't want to use the word incentives, but I can't think of another word for the developers to bring some of these projects to market, to balance out the inventory. So it's some interesting times that we're going to have over the next, 12, 36 months, right?
Yeah, and let's just hope that, the government gets lobbied all the time from various interest groups and industries. But if they can't see that this particular industry is one that they have to show real attention to right now, like, that's going to be the thing that I hope this is not just we went there last week and now it's done and hopefully some stuff gets done. Like, hopefully it actually moves forward. And I know that people in the real estate industry and the mortgage industry understand that this needs to move forward. So hopefully we can continue to yell from the rooftops and get some stuff done in Ottawa.
Yeah, yeah. So this call, we've been talking about perhaps some solutions or at least ideas, and let's just kind of land on this, Dion. Things are still happening. You were just sharing off screen that you actually, in the grand scheme of things, last month was pretty decent for moving and refinancing and things like that, right?
Yeah, I mean, some of it was coincidental in my business, like in yours. We often work on things for 6 months, depending on the complexity of things, and it just seems that a lot of stuff all happened last month. In that we had two large multiplex buildings closed together with a bit of a mansion of a house refinance, a $3 million mansion. So it was a big, busy and big month last month. But yeah, as it goes forward, what I will say is, we've got a lot of buyers who are pre-qualified and are looking at this next 6 month window as a potential window of opportunity. And there's a couple of reasons for that. More product, definitely more product coming to market, more product than we've seen in any other year in the month of September. I think you've probably seen the same numbers, right? And well, let me ask you, Gary, do you find that a lot of buyers and sellers are active in wintertime?
You know what? The mindset is they're not, but you know what? They are. I've had
Yeah.
some of my best months in December for
Yep.
buyers, and
Huh.
people tend to buy and sell 12 months of the year, right?
Yes.
It
But I
it
think the key that you said there was you had a lot of success for buyers in December,
yes,
right?
yeah. Did you catch that?
And
Yeah,
yeah, and so this is what a lot of my buyers and a lot of the realtors that we work with have been commenting, in that if a buyer can get themselves financially prepared for winter, what we find is, well, we all know that if somebody lists their house for sale on December 1st, they're likely in a position where they really do need to sell, because December 1st is not, in my opinion, probably not the best time of year to be starting your sales process on your property, because we're going into the holidays, the weather is terrible. Now, on the flip side, if you're a buyer who's willing to put on your winter boots to go looking at property, you're going to be looking at property from sellers who actually really do need to sell. So winter has traditionally been, as you said, a time for a lot of our buyers. So a lot of our buyers are ready to buy this winter.
yeah, yeah. Motivated sellers. They're putting their home on the market for a reason. They're not just dipping their toe, right? From the seller's
Right.
perspective. Yeah, that's a good conversation to have. And in fact, I'm working on some content, and you people are going to be shaking their head at it. And my message really, to sum it all up in one short sentence, is if you are a seller, do not sell your house right now. Uh, there's a tremendous amount of inventory. Now, on the flip side, there are always reasons why you need to sell, and we need to have a deeper conversation around that. But if it's just to dip your toe in the water, because that's what we've been used to for the last 5 or 6 years, there's no toe dipping, right? There's no toe dipping.
Mhm.
There are motivated sellers out there, and you don't want to be lumped in with those motivated sellers, in a sense, is really the message behind that, right?
100%. Yep. Yep. So listen to your realtor, take advice from your realtor. But if life circumstance is such that you must sell, you've got to make sure you get the right strategy in this market. As I'm sure you're talking with your team about pricing strategy and making sure that we're not dealing with wishful thinking numbers right now. We have to price, as you said in earlier podcasts, right at the market. Right.
Yeah, yeah. And in fact, I held a session the other day with our brokerage, and we talked about what at the market means. And right now, at the market means if it's $1 million, you're coming in at 975. You're not playing around. You don't want to be on the
Right.
market. You want to be in and sold in the market. Anyways, all good stuff,
Mhm.
my friend. As always, remind people how to get
Okay.
a hold of you.
Yeah. Kangamortgage.ca, or find me on Instagram at the Dion Beg.
There you have it, my friend. So, Mr. Dion Beg, that's Dion Beg. That's what I'm trying to say. I'm Gary McGowan. We'll see everybody on the next video. Goodbye for now.
See ya. Thanks, Gary.